AMC stock is down about 1% currently, but look at all of this weekly option activity from institutional investors. 2, April 8th, $29 calls. One of these positions for $92,000, another one for $42,000, and another one for $50,000. And that's not even going down the chain to look at all of the other call activity that expires here in the next 4 trading days. I think it's pretty clear institutional investors are looking for another run this week. A matter of fact, you're seeing 21 orders today totaling $12.11 million, positive order value of 73%. So we're going to get into all of this key information. What the hell is going on today? Why AMC stock as well as GameStop and other more retail stocks, call it that, whatever your verbiage is, I do not care. Why those are down and the market is actually up today. So let's get into it. Hit the like button and subscribe to the channel if you guys are new here and you want to stay up to date with all of this key information. As well as that, if you guys want to come join the trading group, link down below in the pinned comment. You get my buy and sell alerts in real time, source information, talk about different strategies and trades. Whether you are experienced in options or you are brand new in options, that is your way to grow your knowledge base and become involved with the community. So nonetheless, let's talk about exactly what is going on today. So there's multiple things that are actually happening. None of them are really bullish. There's nothing that's like, hey, that's a slam dunk. The market should be rallying off of that. Nothing like that has actually come out today. The NASDAQ up about 1.5%. Russell 2000, though, look at that divergence. Up 0.01%. It's flat, if not negative, by the time you guys see this video. Even the Dow Jones Industrial Average is only up 0.03%. Now, if the Russell 2000 was up close to the NASDAQ like you typically see on these risk on days, and that just means people are buying more risky assets, right? Your NASDAQ stocks, your Russell 2000 stocks on a risk on day, you would tend to see the Russell 2000 as well as the NASDAQ, like I said, up pretty much the same, and the Dow Jones down less, or up less. And that's what you're seeing, but you're not seeing the Russell 2000 actually playing along, and you are seeing the Dow Jones Industrial Average pretty much looking like the Russell 2000 right now. So it's very interesting. I think a lot of this actual bullish momentum is due to obviously the tech sector, which is basically the NASDAQ, right? But it's because Elon did make that investment into Twitter. So other people, it's like that sympathy effect. If one stock has good earnings and it's in that sector of other stocks, those other stocks tend to do well as well. And that's really what is going on. Twitter is up 29% for the day. So you're seeing a lot of other stocks in that realm actually positive on the day as well in substantial amounts. A lot of them. The S&P 500, which is interesting as well, is up 0.40%, but over half of the stocks that are actually in the S&P 500 are negative on the day. But who is positive? Who is positive? I'm glad you asked. Good old Apple. Apple is positive. They control about 7% of the market weighting of the S&P 500. So you can see there's a big divergence going on. Not everything is actually winning today. In your Russell 2000, definitely not in that camp. So you're seeing a little bit of the risk on in the tech sector, but not in the Russell 2000, which is very interesting. And I think it has to do with these catalysts that we're going to see throughout the rest of the week, which is, as you guys do know, the FOMC minutes. That is going to come out on Wednesday, and that is going to move the markets dramatically because that is going to either hammer home this 0.5% rate hike and give us clues about the balance sheet reduction. That's what the markets really care about, is the balance sheet. The Fed, the markets, they know what to expect when you're talking about raising rates 0.25%, even 10 times in a year. It's like, okay, we get that. The federal funds rate is going to be 2 to 3%. Understand that. We can live with that. Now, running off the balance sheet, like I've talked about extensively, or just selling assets off the balance sheet, nobody knows exactly how that will affect the markets. We know the Fed sells bonds. Those bonds drop. Yields go up. That makes cost of borrow capital a lot more expensive. So we know that, but we don't know what kind of correlation there will be. We know 9 rate hikes, 9.25% rate hikes. Cool, fine with that. Don't know about the balance sheet. And that's what really is causing a lot of this instability, call it volatility, where some sectors are up a lot, others are down a lot when they're both in the same risk on sector, if that makes sense here. And a lot of your Russell 2000 stocks, just broadly here, they are ones that would not benefit at all if the Fed did raise rates more aggressively, or if the balance sheet had to be sold or run off starting next month, like Fed Williams said. Those are a lot of your higher growth stocks. Those are your ones that don't always have the greatest balance sheets. Now, we know AMC in a little bit of a different category, but they are summed up in the Russell 2000. So they are definitely going to fall victim to this risk off sentiment for the Russell 2000. And that is what is really going on here. That's why I like to look deeper under the surface. What are institutional investors doing? And that's why I like to look at the option flows, because these are not retail traders. It's simply not. They're not the ones coming out here and putting on hundreds of thousands of dollars in these option trades. They're simply not doing that. So it's institutional investors. And what are they doing? Like I said, 21 orders totaling $12.11 million, positive order value of 73%. The dollar amounts have come down over the last 2 trading days, but the positive order value has actually increased for today. On Friday, it was only sitting at 55%, and today it's at 73%, but yet the stock is down over 1%. I think that implies to me that we will see another move back to the upside, because institutional investors know better than anyone, right? They're not stupid in this regard, that options expire worthless unless they go into the money and you get past your break even. That's why I really like to look at the option activity. Just like Twitter, they had a bunch of unusual option activity before this essentially news came out that Elon acquired 9% of Twitter. It was clear something was going on. Even though this price of the stock may have been going down or slightly even going up, the option activity gives you a clear picture into what is actually going on. But let's take a look at the Ortex data. But first, I want you guys to know that Biden is speaking later on today about potentially putting on new rounds of tariffs and sanctions. Who knows how that'll move the markets? I feel like that's already priced in. I could definitely be wrong there, and it could move markets. Typically, when young Biden does speak, the markets do fall, and then they tend to recover after he stops speaking. But it does say EU's new Russia sanctions to likely include steel, luxury goods, and more, and that comes from different sources. Jamie Dimon, CEO of JP Morgan as well, says confluence of inflation. Ukraine war may dramatically increase risk ahead for the U.S. So pretty interesting takes here. Not too much actual news besides that. There is the talks going on between Ukraine and Russia yet again today and overnight tonight. Nothing is coming out of that. It doesn't look very likely, as Russia is basically just killing hundreds of civilians. It looks like the probability of peace is slipping further and further down the drain. But that big catalyst, like I said, is going to be the FOMC minutes. And what is also interesting is that you're seeing the probability of a 0.5% rate hike going up again today. On Friday, it was only 69.4% chance of this 50 basis point rate hike, the 0.5% rate hike. Now it's sitting at 76%. So it's went up about 5% here. Or what is that, like 6.5% just today. And the markets are going up on that. So it's pretty interesting. You're seeing a lot of divergences here and there. And just to be flat out honest with you guys, I think a lot of your big tech stocks, like your Apples of the world, they have ran too hard, too fast, and they are going to have to come down. At the same time, I think a lot of your other stocks like AMC, a lot of your Russell 2000 stocks have not ran enough, and they will definitely catch up when the large cap stocks do ultimately come down. So I'm going to be watching that big catalyst on Wednesday. That is what is really going to move the markets. Headlines between now and then, between Russia, Ukraine, sanctions, all of that, that can definitely move the markets as well. But the main entree is going to be on Wednesday. And then you do have all those Fed speakers. on a Thursday as well, and they might hammer home this balance sheet runoff or even selling the balance sheet, like Fed Williams said, by the next meeting. And if they're going to do that, they're going to let us know about it this week. They're going to talk about it on the Fed minutes, and then they're going to come out and say, yeah, we need to reduce the balance sheet by next month. And that makes your interest rates for loans like me or you would get go up through the roof. That's why you got the mortgage rates that are ballooning, that are higher than they have ever been since 2013, up 0.5% in just the last 2 weeks. It's not too great out there. And once they start to actually reduce the balance sheet, it makes all of these companies cost to acquire capital go up more, because treasury bonds compete with other assets. So it's like, think about it like this. The easiest way to ever look at this is, why would you lend me your money for, say, 2 or 3% when you could get a treasury bond that yields you 2.5 to 3.5%, and there's no risk on that for the same time frame? You wouldn't do that. So you would charge more premium to me. You would make it worth your while for taking on that additional risk, and that's why mortgage rates and everything else is going crazy. As people sell out of bonds, the price of the bonds fall. That yield, like a dividend stock, is fixed. It doesn't move around all too much. When the price of that comes down, the yield now becomes more attractive and becomes larger, and that's really what the cost to borrow rates are going to be for these companies. So even more so than the increasing the federal funds rate, the thing that really hurts is reducing that balance sheet. And history has showed us stock market fell 25%, the only time the Fed ever reduced its balance sheet in a meaningful way, in late 2018, 2019. But nonetheless, let's get into AMC specific data. That's what you guys need to know. Nothing else as far as news is concerned for the day. But things could develop, so definitely do keep that on your radar. Now, as far as the short interest of free float, that is at 20.78%. Current shares that are sold short of 107.11 million. Cost to borrow max of 3.7%. And you are seeing about 782,000 additional shares that are sold short today, relative to obviously the return shares. So nonetheless, shorts are not covering. They're simply not going to. Somebody asked me last night in the live stream, do I think there's any chance the MOS could not happen? And simply put, I don't think there's a chance that couldn't happen. Shorts are not covering, and that's just a fact. If you were a smart short seller here and you had money on this position, shorting AMC, you would probably cover on your position slowly rather than being forced to get out once a squeeze-like event does actually start, because that's inevitable. Eventually, those squeeze-like events happen, and you'll be forced out of your position. So why wouldn't you not do that? It's an egotistical battle at this point. But like I said, utilization at 100% and days to cover at 2.44%. Option activity as well, very, very bullish, like we already went over. Now, as far as the max pain, let's go ahead and pull up good old Amy. And we could see by this Friday, max pain is $22 per share. So it is very possible that we do close around that, $22 price. That's pretty much where we are at right now. So it wouldn't be a huge shocker there, right? And as far as the yield curve, that is getting steeper, and it's inverting more dramatically. Now we're more inverted than we were during 2019, and we've seen a recession in 2020. It's always an indicator of a recession. So it's not good news for the next couple of years out. Maybe start carrying more cash, well, not carrying more cash on you, but definitely acquiring more cash and being safer in that regard. But the next 12 months are likely to be very bullish for the stock market, unless obviously things do develop. This market is really dependent on a lot of those news headlines, and liquidity is drying up at the current moment. So that's important to also point out. Now, as far as the technical picture, let's go ahead and take a look at good old technicals on AMC stock. And AMC is only down 0.34% right now. We have bounced a little bit since I did start making this video, but it looks like we slightly broke out of line with this trend line. You could obviously adjust it if you wanted to. I'm not a fan of doing that. We are very close to the 100-day moving average though, and you see these wicks on these candles. You're really fighting to stay at higher levels right now. If we do come down, and we come down to $21 per share, in the grand scope of things, that is not all too bad. I hope you guys realize that. That would put us back to these first week, second week of January levels before we really started to tank during this whole last sell-off. So we've basically reverted all of this year's sell-off essentially with this move that we have seen, even if we remain above $21 per share. And it's like we're just waiting for catalyst. AMC is going to move based off of catalyst, and like I've said many times, a stock doesn't just go up, it doesn't just go down. So we've consecutively been going down ever since we did hit $34 per share this day right here. All that manipulation that did take place. The following day we dropped almost 13%. Then we dropped 4%. Then we dropped 5%. Now we're down 0.5%. So we are going to get a bounce. I want to see, when do we get this bounce? How high do we go? What levels do we break out above? And it looks like if we got this bounce, let's say tomorrow or sometime during this week, you would bounce straight back above the 100-day moving average, which is at $23.75 per share. So that's the key level I want to watch. The 100-day moving average, as well as $21 for any potential downside move. The MACD, even though we have been falling, has been very slow to revert back to a more bearish stance, or a less bullish stance, right? You're still seeing the MACD bullish, and the RSI is at 58.04, so that is also on almost the neutral side. Neutral is at 50, so we're heading back down to those levels. Definitely have room for a rally here. We've seen the volume come in. We've seen the volume slowly start to dissipate. Now, what happens when we do get that volume that comes back into the stock? That's what I want to see. How explosive are we? Can we make, let's say, $30 become the next support level when we do get that big rally? So that is basically going to be all for this video. A lot more to cover in the video later on today, so stay tuned for that one. Until then, make some money out there, guys. Hit the like button and subscribe to the channel if you guys want to come trade with us. Link down below in the pinned comment for the trading group, and go ahead and follow me on Twitter. But nonetheless, I'll see you guys in the next one.